Good afternoon, everyone. We are going to start a webinar in a minute or so. We're letting people coming in. Right, good afternoon. I think we can start. So thank you for stopping by and joining us on our first quarter economic and financial markets outlooks and updates. As you guys know, we try to do these webinars at least once a quarter. We took a break in the last quarter of 2025 because we were prioritizing our transition to our new broker-dealer, Cetera, but now we're up and running, and we are very happy that our friends from Russell Investments have agreed to join us again. So, like always, we have Mark Eibel from Russell Investments and also Joe. And you guys know Mark. He's been coming to these webinars pretty much every other time that we do it. It's one of our favorites, and our clients like, everything that Mark has to share with them. So without further ado, Mark, I'm going to hand it to you, and please let us know what's going on out there.
All right. Have we spent enough time on our friendly faces on this slide? Are we good?
Yes, we did. I think
All
so.
right. All right. Well, this one, man, this is getting worse, isn't it? Look at this. All right. So I'm going to hit on about six or seven different slides in this deck. There's 25, so count your blessings. Actually, I'll probably hit on a few more of them, but I like starting with this one. So I'm going to kind of talk about what was going on last year, and then we're going to talk about what's going on more in a moving forward kind of mode.
Perfect.
Uh, we've got 100 years of data. So this is a data source that many of us use, and it goes back to 1926 as far as returns just in the US, and that gives you, that's 100 years worth of data, which is kind of cool. We've shown this slide before, but now that we can say triple digits, to me, I mean, this is just the ultimate proof statement about the powerhouse that has been the US economy and the US market, right? What you see on here is just bucketing returns in 10% increments. So everything to the right of zero was a positive year, everything to the left was a negative year. If you want to add them all up, 74 of them are to the right. So basically, three-quarters of the time the market is up. What jumps out at me is go to the 20% and higher. I mean, that is not an insignificant number of periods where the market absolutely just kind of had a great year. You can see in the orange where last year was, it was a great year for the US. But what's interesting about last year, and we'll talk a little bit more about this in a few minutes, we weren't even close to being the best asset class. Emerging markets was up over 30%. If you want to take a slice of non-US and just look at the more value-oriented stocks, so not the technology kind of growth names, they were up over 40%. Just a remarkable year everywhere. What also jumps out at me is if you go to the negative side, and if you go to the negative 20 or worse, it is literally a handful of years. And three of those years were in the 30s. Okay. 1930s were not a good time in the marketplace. You take out those names, and you're literally, I mean, you're talking about 2008. You're talking about tech bubble. I mean, it's pretty dramatic events, huge oil crisis in the 70s. There's just not that many observation points. So, in a year where, again, take yourself back a year right after the election, and it always is the case where about half the time in life you win and half the time you lose. And usually when you win, you're kind of happy. And when you lose, you're kind of sad. Well, this election was more if you won, you were really happy. And if you lost, you were really sad. And there were a lot of people who said, I don't want any part of this market. I don't want to be involved in this. And I'm going to get out. And man, you lost a year. Again, it was good everywhere. I mean, we have a slide here that we often use what worked and what didn't work. There's nothing really to say. This could just be what worked and what really worked. There was nothing on the what didn't work side. It was all positive last year. So a great year to make sure you just stay in the game. And if you need to dial or take risk down at times or turn it up, do that in concert with Elier, but just don't do the dramatic I'm all in or I'm all out because you just don't know. And last year, you would have left a really nice year. And it doesn't matter, again, how you were allocated. If you're more conservative, fixed income had a good year, which we haven't seen for a while. You're just clipping that nice 4 or 5% coupon. And you did a little bit better than that because rates drifted down and the value of your bonds moves up. So, again, just kind of a phenomenal year. All right, so let's dig into a little bit more about kind of the US, and we're going to talk US, and this is going to drift into US and non-US. I haven't been able to talk about non-US in favorable light for a while, so we're going to talk about what drove that, and we're going to do that over the next few slides. So, obviously, over the last few years, the story is in the US has been the Mag 7, right? These 7 incredibly large names, not all officially classified as technology companies, but basically technology companies funding this AI spend and really have driven portfolio returns. And so what you've seen over the last few years, if you look at 23 and 19 and 2024, I mean, the S&P did great, was up over 20% both years, but it was largely driven by this handful of names, right? And you can see some pretty phenomenal returns. NVIDIA's, of course, been the leader of the pack, but I mean, different ones have also had tremendous leadership. 2025, not so much, right? Market did well. Different leadership. It was really kind of the Mag 2 this time. NVIDIA still did well. Google had a better year. Others didn't do as well as the market. So last year, I'll take last year all day long. I mean, I won here, but I won by owning a lot of different things. It's an easier portfolio to own when you win a lot of different places. And just to kind of put it in scale, the US is 70% of the world's market at this point because the last 15 to 20 years have been dominated by US and particularly technology and growth names. Okay, so we're 70% of the world's market cap. Of that 70, about 35 or 40% at the end of 2024 was in these 7 names. So I mean, 40% of 70% is a significant number of just the size of these companies when you look at it, not just in the US space, but in the world space, right? I'm not comfortable with all of our retirements kind of being driven by 7 names that are all basically, again, trying to do the same thing, and they're not all going to be equally successful. We saw that in 2000, where Microsoft was the real survivor, and a lot of other names that were doing well at that time faded away for a long period of time. So I like the return pattern for 20 that we saw in 2025. And again, in a balanced kind of a framework, my bonds helped me. My 40% actually contributed as well. So I think you're going to continue to see this pattern move forward. Now, I don't know if we'll get returns like this moving forward, but at least the dispersion, the creators have been paid is kind of the way I always think about it. And now you're starting to see it spread out, which usually leads to another question, which is, okay, so we're going to go back to this. Yeah, we're going to go back to this one, which leads to, okay, so the U.S., we're setting all-time highs every other day, it feels like. Why would I want to invest in the U.S. market when the market is up? So before we get into the details of this chart, one thing I always tell people is, well, keep this in mind. Remember the first one I showed you. 74% of years, the market is up. Meaning, you spend a lot of your life at all-time highs or near all-time highs. So if you don't want to be invested when the market is in that territory, you're going to be out a lot. Number one. Number two, if you want to trim an asset class, whether it's us or anybody else that's done really well, and we do it all the time, it's called rebalancing, and buy into an asset class that's underperformed. And if you're doing this on the edges, yeah, I think that makes sense and that adds value over time. But if you tell yourself, well, I'm going to get all the way out of an outperforming market, we'll use the US as an example, and then I'll get in when it gets cheaper. I don't think you will because you're a human being and we're all kind of wired the same way. And whatever causes that downturn is going to scare you and you're going to think it lasts longer than it will. And you're going to miss the bottom. And then it's usually pretty sharp off the bottom. And now you've missed it. So you waited for an opportunity logically ahead of the time. But when the moment of kind of rubber meets the road happen, it's very hard to pull the trigger to get back in. So you kind of get into this behavioral loop where you don't want to be invested in markets when they're up, but you don't want to buy them when they're low. You got to deal with longevity. That's the issue to worry about. So staying in the game and with your plan, and again, tweaking and making adjustments, all fine with that. Just don't blow in and blow out. Now, that's all kind of a background to when people say, well, why would I want to be in the US? Because it's so expensive. And that's an absolutely true statement. The US is more expensive. I mean, we've been on a great tear, and you see that in the bottom half of this chart. A common valuation measure, PE ratio, simply what price am I paying for the earnings that I'm getting, right? Well, we're above 20 in that ratio. Now, we'd be even higher on that ratio, except the earnings have been phenomenal. And that's what you see in the top part, right? The profit margins in orange is the US. And for, again, such a developed market, 100 years plus of data now, our earnings are doing better than they've like done in a long period of time, meaning you can justify staying in the US because it isn't just that the prices are getting out of control, which we saw more in the 2000 period when these technology names took off in that period. Hard to believe it's been 25 years now. When they took off, they didn't necessarily have the earnings support. They just threw .com at the end of their name and they got a higher valuation. These are real companies with incredible earnings that are trading expensive, but they're still funding it. I mean, it's unbelievable, right? So we're very comfortable with our 2/3 US, 1/3 non-US kind of allocation. We're glad we have non-US. We like the US story. We know we're paying up for it. But man, I love that orange line in the top part of the chart. I'm going to go back a slide. Here we go. Why don't I hit the right button and then we'll go back and hit on an area that's kind of related to this. The non-US story. So the non-US did outperform last year and is having a good year, again, particularly emerging markets. And the question always comes up, so what's driving this? Is it that all of a sudden these companies have just gotten like really good overnight? Or is it just that their stock prices are so much cheaper because they haven't done as well as the US over the last 20 years? Or what about this dollar impact that I hear about all the time? So this slide kind of helps us unpack that one. And the answer is kind of yes, yes, and yes is the answer, okay? So what this shows on here, and I know it's messy, but hang with me. So the currency impact is in the gray. What happens is, and what you can see on here is, I mean, you go from like 2011 through 2026, I mean, it's gray a lot on the bottom. The US dollar's been strong for about 17 or 18 years. And there's a lot of good things that come from your currency being strong, but there are some benefits that come as an investor when your home currency is weaker. And that's what we're going to talk about right now. So the dollar has weakened. Now, currencies are like any other asset class. You can buy them cheap and sell them when they get more expensive. So from a matter of it's been strong for nearly 20 years, I think people have taken some money off the table there. I think that's one of the drivers. Are there people saying US exceptionalism is in question? There's so much drama on a daily basis. What's going on in the administration? I think I'll park some money elsewhere. Yeah, I think that's part of it. I think that's why gold has had such a phenomenal run because some of that money is finding its way into gold and some of that money is finding its way into international markets. So the currency impact is real. And in shorter periods, the currency impact might be the biggest driver. And I think the easiest way to conceptualize that is kind of think I travel a lot based in Seattle. So we all know whenever we go east, any of us, I know where you're all located. It might be let's say we go on a flight for 1,000 miles, right? It's 1,000 miles to get there, and I'm traveling east from the West Coast and 1,000 miles to get back. Same 1,000 miles. That's kind of the return that you get when you're in a local market. The return is whatever it returned, right? But when I travel east, I seem to land earlier. And when I travel west, it takes me longer. I think of that as the currency impact. I get a tailwind when I'm going east. So not only do I go 1,000 miles, maybe I get there in 2 hours. Well, when I do the same exact trip going west, I do the same 1,000 miles. I get the same local return. But now it took me 2 hours and 20 minutes to get home, right? That's kind of a negative experience. My flight took longer. That's a headwind. That's currency. Currency helped me as a tailwind when I was going west, hurts me when I go the other direction. Think of it that way. When you make earnings returns outside the US, the return is the return. You've earned it in the local market. But you want to translate it back into dollars because that's how we spend our money. When the dollar's cheaper, it's kind of that tailwind going west. You get more return, you get more bang. When the tailwind, when the dollar is expensive, well, it's like anything else in your life. If something gets more expensive, you buy less of it, right? I don't care if it's gasoline, bananas at the store, investment returns. I might have earned my 1,000 miles, but I lost a little bit of it when I moved it back into my stronger currency. I gain when I weaker currency. So that's a long way of kind of saying currency is a driver. A weaker currency will boost up your non-US returns, and we saw that last year. Well, I think this can continue. The dollar's probably has more reasons to weaken than strengthen from here, if for no other reason. It's just been so strong for so long. But even if it just kind of stays where it's at or weakens a little bit, it'll help your returns. Now, does that mean currency is the only reason I want to own it? No. They are cheaper stocks. And they're great companies, and they are products that you use every single day. And a lot of them are not technology led. You get a nice offset. You can get a lot of really high quality financial companies, consumer companies, energy companies, healthcare companies. They're all bigger weights outside the US because technology is such a big weight in the US. So it's a great offset for exposures, and you usually get a bigger dividend along the way too. Non-US companies tend to pay back more dividends than US companies. We pay dividends, but companies also redeploy that money into share buybacks, which is a way that you can make price appreciation, but pure dividend plays are more prevalent outside the US. So when I look at non-US, again, very comfortable having a third of our money there because I get cheaper stocks that are really high quality. I get a bigger dividend along the way, and I get an offset to my currency, and I get sector exposures that I don't necessarily, I'd have to pay up to get them here. Long way of saying that's why we're two-thirds, one-third, and we're comfortable about it. But I like to kind of peel the onion back because currency is complicated, and kind of when does it help you and when does it not? All right, let's move on. We've already hit on that one. I'm going to move forward. We're going to talk a little bit about, let's talk a little bit about kind of 60-40 and a little bit of Fed speak on this one. So I like that. Want to make sure I've got okay. Yeah, I like this one because of the simplicity of the chart, right? And to me, this is probably the basis of a lot of your meetings, particularly as you head into a new year. And, I'm not saying 60-40 is the way you have to invest your money, but a lot of money ends up in that range of it gives me enough return from stocks to fund my retirement and deal with my longevity, but it gives me something else that when stocks misbehave, I don't get spooked out of the market, and a lot of money ends up in this range. All right. So the math on kind of how we get here is on the right, but you don't have to do any of the math if you look at the left. So going into the year, what's kind of a reasonable expectation for what stocks can do? And I think that 5 to 10%, we're already doing really well, but 5 to 10% is always kind of a logical starting point, I think, unless something really extreme is going on in the markets, right? Now, in that first chart, we showed we've averaged over 10% for 100 years, but I would rather just kind of assume okay, we've had some really good years. I think you can do 5 to 10. I think non-US might beat the US again, not because the US is going to fall apart, but for the reasons that I mentioned. So I'm kind of starting with, from my stock mentality, kind of maybe in that upper right-hand corner. Well, what about when I add in the 40% of bonds on the left side? So we kind of bucketed a few different ways. What if interest rates drop? What if they don't do anything? And what if they go up? And as we look at the probabilities of what scenarios can play out, I'm going to put myself in they don't do anything. And if they go any direction, they probably drop. They probably, at least in the maturities, the cash to 2 year, because that's what the Federal Reserve kind of controls, right? And I think there's more reasons with a weakening labor market. Inflation is the one to watch out for. There are people on both sides of this equation on could inflation pick up or not. We'll talk a little bit more about that. We're going to have a policy slide in just a second, and we'll kind of weave inflation and tariffs together in that conversation. But I'm going to go with it probably is a no Fed cuts to maybe one or two as the year moves on. So that kind of puts me into the fall category. And when I go to that for top two lines and I move over to the 5 to 10 range, this is where I get if I'm planning in my mind what I might expect from my 60-40, I think these numbers are kind of right in the range. And I bet they're pretty close to your planning assumptions. So to me, it's just a nice way to kind of frame the conversation about what can we expect from markets? What do we think interest rates are going to do? And when we blend those together, I mean, is that a 2% return expectation, a 12? I think that 6, 7% returns kind of makes some sense. Let's talk a little bit about what could influence on that Fed decision. So we all know that Powell is probably literally counting down the days to when he will no longer be chairman of the Fed. It's been a very interesting road for him. He got to be Fed chair during a global health pandemic. And then he got to be Fed chair during a tariff kind of environment and an administration. And to be frank, most, if not all, administrations always pick on Federal Reserve heads because it's always a one-way conversation. They can say anything they want to, and the Fed chair is not going to say a word back, right? So, but this one, as with most things, is a little bit more exaggerated no matter what the issue is when it comes between the administration and whoever's on the other side. But that being said, Warsh has been named as his replacement. And what's really interesting is if you had asked me a year ago who I thought it would be, he would have been the name I would have thought. And then his probabilities dropped as all this other conversation happened. And then he turns out to be the guy. And the market was a little bit surprised at that. But I bet if you had gone back to interviews that a lot of people did a year or two ago, they might have forgotten that they thought this would be the guy who has a background with the Fed. What's interesting is that we all want to know is, well, what does this mean for policy, right? And you would think, well, if this administration has picked him, he better lower interest rates because he's been telling Powell to lower interest rates. And whether or not Powell should be or not would be another call. I think Powell's done a decent job in analyzing the data that he's been given. But you would think, okay, well, rates are going to go down because Trump picked this guy. Remember, Trump also picked Powell, which people might forget. So, but if you look at Warsh's background, he's tended to be one of these guys who has been more on the side of keeping rates where they're at or higher in any of his conversations that he's been in over the last year. So in other words, if you want to lower rates, you're a dove. If you want to raise rates, you're a hawk. He's been more hawkish, but he just got picked by a guy who's kind of saying, I'd really like you to be dovish. So the answer is we just don't know. But I think, and I mean, he knows how the Fed works. He's understood it. He's been inside of it. He's never been a Fed chair before, but he's been inside the Fed kind of setup. I'm hoping that he'll bring both sides of those brain to him. And remember, I mean, there's 12 Fed governors, and it's just not his opinion, and he'll get opinions from both sides of it. So I hope he's open-minded. That's what you want in your Fed chair. His background tells me that he will be, but I guess we won't know until it plays out. The market did not have a large negative reaction with his name being picked, though, which is the market's way of kind of saying, jury's out, but we're going to give this guy a chance. So we'll just have to wait and see. So anyways, a long way to kind of get at a little bit about what's going on with the Fed and what might you expect from returns this year. Of course, we don't know what markets will do, but I think this is a decent framework to look at it. This kind of ties in. We talked a little bit about inflation, which I think is going to sit in this 2.5% to 3% range for a while. Let's talk a little bit. What does that mean for tariffs and some of the other policy ones? So this slide is really kind of designed for the policy lovers in the room. Okay. What this shows is on the far right side is our view of what the U.S. economy is going to do. GDP, the common measure, right? We think we're around 2.5% for this year, running a little bit hotter now, but we think year over year, maybe around 2.5%, which quite frankly, for an economy of our size and our demographics and getting older and all that kind of stuff, that's a solid number, right? Well, the question is, how did you get there? And this just breaks it down. So you see, most of it comes from trend, the far left side, meaning we're kind of a 2% growing economy. We're a 2/3 led consumer economy. And we can argue, which consumers are doing all the spending and are the wealthier carrying it. But quite frankly, the wealthy consumer has always been the spender for decades. Trend growth is kind of 2% in the United States. So we kind of start with that as a base case. And then we either subtract it or add it based on a lot of policy decisions, a lot of these being what's going on with whatever administration's in charge. So let's talk about the ones that are a little bit more negative. Uncertainty in the middle is always a negative, so it's always kind of there. Tariffs and immigration, more negative for markets. And those were really the policies that got the highest emphasis in year one of the administration, right? No surprise that as you get into year two, you get closer to midterm elections, and the things that are a little bit more market friendly get emphasized before midterm elections. But let's just kind of quickly walk through this. Now, I'm not making any sort of societal judgment on any of these. Are tariffs good or bad? Is immigration good or bad? We can argue that all day long. What I'm just saying is, does the market like it or not? And if I look at these in isolation, which of course the world doesn't run in isolation, but in isolation, are tariffs good or bad for the economy? Well, they're generally not good. Why? Because it's someone's paying it. Either you and I are paying it, or the importing company's paying it, or they're negotiating with the exporter for a better price. Someone is paying it along the way. And it's really difficult to carve out how much is being paid because there's so many other factors going on. But left to their own devices, yeah, should inflation move up a little bit because of tariffs? Yes. Has it done it in an obvious way? No. I think some of that is because, I mean, remember, we had tariffs under the first Trump administration. They stayed in place during the Biden administration, and then there were threats of them going a lot higher, and they're coming down as time moves on, meaning the change in the tariff levels for quite a period of time now hasn't really been that much. And so companies are adjusting, we're adjusting, importers as exports. But on the whole, are tariffs probably a little bit negative for the economy? Yes. Immigration, probably yes. Why is immigration policy right now a negative? Um, the border is closed, and again, we can argue that's good, that's not good, separate kind of societal political question. From an economic standpoint, if you close the border, you're cutting off workers coming in. If you look at the workforce growth over the last 5 to 10 years, a lot of it's come from immigration. So you've basically taken the supply of new workers out by closing the border. That's just one of the ramifications of it, right? You also have a country that's getting older demographically, having fewer kids, so that the supply is not coming from there. And now you have the AI effect, which is really hitting college grads. And any of you who have college grads know that depending on their field of study. So you've got these drivers that are kind of eliminating supply of labor. That's not good in general for economies. Now, we've kind of gotten away with it because the demand for labor has dropped. Part of that's because AI is an efficiency and productivity gainer, right? So we've got this offset between demand and supply. But if they get out of whack with each other, yeah, you could really see the impact. But left to its own devices, the current immigration policy is probably more of a negative than a positive. Now we move to the right as we work our way through. Financial conditions is what the Fed's doing. We've already talked about that. They're either going to keep rates where they're at or lower them. Lower interest rates tends to be good because lowering borrowing costs, and we'll spend more money and we'll get mortgages and all that kind of stuff. I think we're kind of in the status quo range, particularly on mortgages. Remember, the Federal Reserve doesn't control mortgages. The administration is all about things that are like my mortgages, like the affordability conversation. The Fed controls the cash level to maybe up to 1 or 2 years in maturity. After that, it's the market deciding what does inflation look like? What do some of these drivers look like further into the future? So I think the mortgage rates that are sitting at 6 or a little bit lower, I think this is where we're at. And if you actually look at history, they're still cheap, right? My first mortgage was almost 10%. My dad tells me about his 18% mortgages in the 70s. I've heard all of that. All of that falls on deaf ears to my 26, 29, and 32-year-old who goes, no, Dad, mortgages are only at 3.5%. This 6% stuff is out of control. History's not on their side with that argument, right? So I think mortgages are going to probably sit right about where they're at right now. And I don't really see them moving too much, at least not too much further down, maybe drift up a little bit. All right, fiscally, that's debt. We run both sides of the aisle, spend more money than we bring in. We can argue that's bad in the long run, but economy likes it because no matter where it comes from, whether it comes from our savings or whether it's deficit funded, think of it as our own credit cards, and we're spending, it's good for the economy. And then last is deregulation. We could argue all day long, is deregulation good or bad? We could have that argument, but does the economy and the market like it? Yeah. Why? Because regulation's an expense, maybe a necessary, justifiable expense, but it's an expense. You lower an expense to companies, particularly if they're smaller companies, it helps their earnings. Goes back to that earnings portrait that we showed earlier on. So the reason I like this is yes, largely on the edges, we think the issues, particularly in year 2 of the administration, probably add a little bit to the economy. But I just like this because it kind of gives you a framework. And all of these issues are being talked about like hourly. It's exhausting, right? But it helps you kind of frame what helps and what hurts, separate away from how it might be positioned depending on which side of the aisle is making the argument on what does it really mean for the economy. We don't think we're in a recession. We think this is how we kind of get to it at the end of the year as far as economy. All right, let's close up. This one kind of rhymes with the first one. So, you might say, okay, well, what if I invested right before the tech bubble? And what if I invested right before 2008 with the financial crisis? And, what if I invested right before COVID? I mean, how many years? It must have taken a ton of time to get money back. And what this shows you is it doesn't really take that long. These are pretty dramatic events, right? And they're recent enough in history. You remember them, right? This isn't a chart anymore. This is your life, right? You have lived through a global pandemic and a near depression environment in 2008, a near setup of that within a 12-year period. It's pretty remarkable, right? And this just shows, yeah, your portfolio went down at the outset, but look how quickly you got it back. And again, I always point people, you really want to worry about something? Worry about longevity. I just took my 92-year-old dad to his wellness appointment, which is kind of hilarious in a way, right? Because most of the issues that come up, the doc says, well, that's not going to kill you. So do you really want me to do the blood work or do you want the medicine? Because if you don't want to know the answer, that's not what's going to probably take. I mean, the conversation is just so different than I want to used to, right? But we're all kind of dealing with this as we live so long. So, time is your friend, and investing is the same way. So this is kind of rhymes with the first slide of kind of stay in the game. So, all right, I went longer than you probably wanted me to go. I only hit on a third of the deck, so be thankful. But I
No,
think
that's
these are
good.
some of the themes that I hear all the time, a little bit of a look back, a little bit of where we're at. And by the way, so far in first quarter, 60-40 portfolio is probably up 2.5%, 3%. We're off to a great start. I would take that return, if it was June 30th, halfway through the year, I'd say, hey, we're on a pretty good pace here. So another remarkable start with winners across the board right now. So we'll see where we go. But anyways, that's where we're at. So back to you guys.
All right, Mark, thank you so much. I mean, you pretty much touched based on all the questions that we received ahead of time. And basically, looking here at everybody that has attended the webinar today, just a quick reminder. Remember, we always start with you guys, most people, with a financial plan. And then during that financial plan, we discuss all your goals, your time horizon, and then based on the numbers, kind of like we estimate what's the target rate of return that we need to achieve your goals. And then based on that, then we go into the tools and figure out what type of portfolio we need to implement. And then from that point on, we adjust as we go. But everything pretty much in the last as we have been saying, the last 3 years, the numbers have looked pretty good. And then just starting this year also. But I don't see any other questions coming from our attendees today, Mark. So I think we are good to close. Thank you so much. Like always, we are very thankful that you accept our invitation every time we reach out. Thank you, Joe, and thank you, Russell Investments. And then for everybody else, thank you so much for attending today, and we'll see you in a couple of months. Thank you.
Thanks for the opportunity. Until next time.
All right. Bye-bye.
Thank you, Elier.